If you've ever opened your banking app and seen your credit score sitting there and felt weirdly proud of it, like, okay, I'm doing something right. But at the exact same time, you've got a car payment, a couple of credit cards, maybe a personal loan, maybe student loans. And somehow, even though your score is good, you still feel broke, like you're playing the game correctly. But the game isn't actually making you wealthy. That's not just you, that's the system. And here's the thing, there's a flaw in the credit system. A structural flaw. And once you understand it, you can use it completely in your favor. My name is Tom, and I spend way too much time thinking about how the credit system actually works and how normal people can quietly use it to build wealth instead of staying trapped in payments. If you're someone who works hard, pays your bills on time, tries to do everything right financially, but still feels like you're not getting ahead, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because today, we're breaking something open that most people never question. Let me start by challenging something. We've been told, build your credit. Good credit is everything. Use credit responsibly. But no one ever explains what the system actually rewards and what it doesn't. Here's what most people don't realize. The credit scoring system was never designed to measure wealth. It was designed to measure profitable borrowers. That's not me being dramatic. That's literally how it works. The most widely used scoring model in America is FICO. FICO scores are used in about 90% of lending decisions in the US, and FICO breaks your score down roughly like this. 35% payment history, 30% credit utilization, 15% length of credit history, 10% credit mix, 10% new credit. Now look at that carefully. Notice something missing? Income, net worth, savings rate, investment behavior. None of that matters. You could have $500,000 invested, no debt, and a low credit score because you don't use credit. Or you could make $60,000 a year, have $45,000 in car loans and credit cards, pay everything on time, and have a 780 score. The system isn't rewarding financial independence. It's rewarding consistent participation. That's the flaw, and it works in your favor once you see it. Let me tell you a story. A guy I know, we'll call him Mike. Mike did everything right. Got a job out of college, financed a car, opened 2 credit cards, took out a personal loan to consolidate debt, paid everything on time. By 30, his credit score was 790. He was proud of that number. But when we looked at his finances, he had $22,000 car loan, $9,000 credit card balance, $14,000 personal loan, at an average interest rate of around 8%. That's $45,000 in debt. At 8%, that's $3,600 a year in interest. Every year. That's $300 a month evaporating. And here's where it gets really interesting. If Mike instead had no debt and invested $300 per month into a low-cost index fund earning 8% annually, in 20 years, that's about $177,000. Instead, he's paying $3,600 per year to lenders. The difference over 20 years? Well over $200,000. Same person, same income, different direction of money. That's the system. Now you might be thinking, okay, but you need good credit to buy a house. Yes, you need access. You don't need permanent participation. And that distinction is everything. The flaw in the credit system is this. You don't need to carry debt to build credit, but the system subtly nudges you to. Psychologically, behaviorally, culturally. Let's talk about that psychology for a second. Because this isn't just math, it's behavioral design. When you swipe a credit card, your brain processes it differently than when you hand over cash. Multiple studies from MIT have shown that people are willing to pay significantly more, sometimes up to 2x more, when using credit instead of cash. Why? Because the pain of paying is delayed. The brain doesn't feel the loss immediately, and the system knows that. Credit cards generate billions in interest and fees. In the US alone, total credit card debt recently surpassed $1 trillion. That's not accidental, that's design. But here's the twist. The scoring model only really cares about, did you pay on time? Did you keep utilization low? Did you avoid excessive new accounts? It doesn't require you to revolve balances. In fact, paying interest does not help your score. Let me say that again. Carrying a balance does not improve your credit score. zero benefit. The myth that you need to carry a small balance is just that, a myth. So here's the flaw. The system rewards responsible use, but profits from irresponsible use. Most people mix those up. You don't have to. Let's break down the math in a super simple way. Imagine two people, Sarah and Jake. Both make $70,000 per year. Sarah uses one credit card, spends $2,000 per month, pays it off in full every month, keeps utilization under 10%. No car loan, no personal loans. Jake uses 3 credit cards, spends $2,500 per month, carries $8,000 in balances, pays minimums, financed a $30,000 car at 7%. After 5 years, Sarah has excellent credit score, $0 interest paid. If she invested $500/month at 8%, she has about $36,700. Jake has also a good credit score if he never missed payments, paid thousands in interest, minimal savings. From the outside, they look similar, but financially, you've got a car payment, a couple of credit cards, maybe a personal loan, maybe student loans. This is where it gets really interesting, because once your score hits roughly 700 and 6,780, you've basically unlocked top tier rates. There's no gold medal for an 830. The difference between 780 and 820 in real world lending terms? Often negligible. So why do people obsess over squeezing out another 20 points? Because the system gamifies it. It feels like progress. But real wealth isn't measured in points. It's measured in assets. Now let's zoom out. The Federal Reserve has consistently shown that a large percentage of Americans would struggle to cover a $400 emergency expense with cash. At the same time, millions of people have access to $10,000 plus in credit. So that's not financial security. That's rented liquidity. It feels safe, but it's not the same as having money. And that psychological substitution is powerful. When you have available credit, your brain relaxes. It feels like you have a cushion, but it's borrowed. Add interest. The flaw? The system counts available credit as positive behavior, but it doesn't measure whether you're building real safety. So here's how you flip it. Step 1, use credit as a tool, not a lifestyle. 1 or 2 cards. Set autopay to full statement balance. Never carry interest. Step 2, keep utilization under 10%. If your limit is $10,000, don't report more than $1,000. You can pay it down before statement closing if needed. Step 3, stop financing depreciating assets. A $40,000 car at 7% over 6 years? That's about $8,900 in interest. And the car is worth maybe half by the time you're done. The system will happily give you that loan because you're profitable. But profitable to them doesn't mean profitable for you. Step 4, once your score is in the high 700s, shift focus aggressively toward assets, index funds, retirement accounts, real estate if it makes sense. Because here's what most people don't realize. A credit score can get you access to opportunity, but only assets create freedom. That's the pivot. Now you might be thinking, okay, but leverage builds wealth. Real estate investors use debt. Yes. Strategic debt, productive debt, debt that buys assets that generate income or appreciate, not lifestyle debt. There's a difference between borrowing to buy a duplex that cash flows and borrowing to buy a vacation you'll forget in 18 months. The system treats both as neutral as long as you pay. Your job is to treat them differently. Let me give you one more number that changed how I think. If you invest $500 per month at 8% for 30 years, you end up with about $745,000. $745,000. That's not flashy. That's boring consistency. But here's the kicker. If instead you're paying $500 per month in interest and car payments that don't build equity, that's the opportunity cost. The flaw in the credit system is that it doesn't punish you for staying broke. As long as you pay on time, it says, good job, even if you're not building anything. And that's what frustrates me a little, because people think they're winning when they're just maintaining. So here's your action plan starting today. Pull your credit report, not obsessively, just understand it. Pay every card in full, every month, no exceptions. Keep utilization low. Avoid financing consumption. Once your score is strong, redirect mental energy to net worth. Track assets, not just credit score. Watch your investments grow. Because that number, that's the one that changes your life. Look, the credit system isn't evil. It's just built for lenders. But once you understand the rules, you can play it better than the average person. You can build a high score without feeding it interest. You can unlock access without becoming dependent. And you can redirect the difference into investments that compound for decades. That's how you use the flaw in your favor, not by rejecting credit, not by worshiping it, but by understanding it. And once you see it, you can't unsee it. If this shifted your perspective even a little bit, hit the like button so more people see it. And if you want more breakdowns like this, where we tear apart the systems that quietly shape your money, subscribe to the channel. Because we're not here to chase points. We're here to build wealth. And I'll see you in the next one.